On a crisp Monday morning, the financial world awoke to a moment that redefined the boundaries of possibility. All across news outlets and social media feeds, a single, electrifying number blazed through the headlines. Bitcoin had pierced the elusive barrier of $120,000 per coin. For some, this milestone was the unmistakable dawn of a new financial epoch, one where digital currencies could finally challenge the supremacy of traditional money. For others, it was a warning siren, echoing the excesses of past financial manias and raising the uncomfortable question: are we teetering on the brink of another spectacular crypto bubble? To understand the magnitude of this moment, we have to rewind over a decade. The story of Bitcoin is not just a tale of price charts and market speculation. It's a saga of revolution, resilience, and radical innovation. Conceived in the dark aftermath of the global financial crisis of 2008, Bitcoin emerged in January of 2009. Its enigmatic creator, the still unidentified Satoshi Nakamoto, envisioned a currency that would exist beyond the reach of central banks and government intervention. The idea was simple yet profound. Build a global payment system where trust was not placed in banks or bureaucrats, but was instead encoded in mathematics and cryptography. In those early days, few paid attention. Bitcoin was the fascination of an obscure subculture: cryptographers, visionary programmers, and cyberpunks who debated its merits in online forums. Transactions were rare, and the first ever Bitcoin purchase, 2 pizzas for 10,000 coins, was, at the time, a quirky anecdote rather than a harbinger of things to come. Yet, even in those humble beginnings, the seeds of a financial revolution were being sown. As the years rolled by, Bitcoin's story became a roller coaster of dizzying highs and gut-wrenching lows. The world watched as Bitcoin rocketed in price during the heady peaks of 2011, 2013, and then again in 2017, a year that saw Bitcoin's value climb from under $1,000 to nearly $20,000. Each ascent was followed by sharp corrections, leading mainstream commentators and regulators to alternately hail Bitcoin as the future of money or condemn it as a dangerous fad. But what is it that sets Bitcoin apart from every other digital currency experiment in history? The answer lies in its architecture. Bitcoin's supply is rigidly capped at 21 million coins, a number hard-coded into its very DNA. Unlike fiat currencies like the dollar, euro, or yen, which can be printed in limitless quantities at the whim of central banks, Bitcoin's digital scarcity is absolute. This scarcity is not just a technical detail. It is the heart of Bitcoin's value proposition. In a world where inflation quietly erodes the purchasing power of money, Bitcoin offers something radical: a store of value immune to monetary debasement. Over the past decade, this promise of scarcity has become a magnet for a growing array of investors. What began as a playground for retail speculators and tech enthusiasts has steadily attracted the giants of global finance. Pension funds, sovereign wealth funds, and even national treasuries have begun to wade into the crypto waters. One of the most headline-grabbing examples is El Salvador, which, in a historic move, adopted Bitcoin as legal tender in 2021 and continues to hold it as part of its national reserves. This experiment has inspired fierce debate. Some see it as visionary, others as reckless, but it undeniably marks a turning point in the mainstreaming of cryptocurrencies. The past year has witnessed yet another seismic shift. In the United States, financial regulators have started to lay the groundwork for widespread adoption by allowing the creation of regulated investment products that track Bitcoin, such as exchange-traded funds, or ETFs. This development cannot be overstated. For the first time, millions of mainstream investors, ranging from Wall Street professionals to everyday savers, can access Bitcoin through familiar, regulated channels. Professor Ravi Sarathy from Northeastern University captures this moment succinctly. Portfolio managers now have the option to include assets like Bitcoin in their high-risk, high-return baskets. This simply wasn't possible before. This legitimization has unleashed a new wave of demand, but it also brings fresh challenges. As Bitcoin becomes intertwined with the machinery of global finance, questions of risk, volatility, and oversight become impossible to ignore. The influx of institutional money, from giants like BlackRock and Fidelity to hedge funds and family offices, has added both stability and turbulence. On one hand, larger players tend to trade in more predictable patterns, dampening some wild swings. On the other hand, their huge capital inflows can amplify both rallies and crashes, making the market more sensitive to regulatory news or macroeconomic shocks. So what's really fueling this latest, gravity-defying surge to over $120,000? The answer is complex. woven from threads of optimism, speculation, and shifting global dynamics. Bullish voices like Cathie Wood of ARK Invest argue that we are only scratching the surface of Bitcoin's potential. Wood envisions a future where Bitcoin is not just a speculative asset, but a foundational pillar of the digital economy. Meanwhile, Michael Novogratz of Galaxy Digital points to a tidal wave of institutional buying as the primary engine behind soaring prices. These investors, he argues, are not just betting on Bitcoin, they are hedging against the instability of the traditional financial system itself. Yet not everyone is convinced that this rally is built on solid ground. Professor Ravi Sarathy offers a note of caution. It's possible there's a bit of a bubble building, and the activity of corporate treasuries may be propping up prices in unsustainable ways. This is not just idle speculation. Companies like MicroStrategy have become notorious for their aggressive Bitcoin accumulation strategies. Since 2020, MicroStrategy has loaded its balance sheet with billions of dollars worth of Bitcoin, making it the largest corporate holder in the world. As of this June, at least 126 publicly traded corporations have Bitcoin on their books. A staggering testament to the asset's growing legitimacy, but also a potential source of fragility if market sentiment sours. The participation of inexperienced corporate treasuries and retail investors has introduced a new kind of volatility. Unlike professional asset managers, many new entrants may not fully grasp the risks involved, leading to herd behavior and exaggerated price movements. The regulatory environment, meanwhile, is struggling to keep pace with these rapid developments. In the absence of clear rules, the market is vulnerable to sudden shocks, whether from security breaches, regulatory crackdowns, or shifts in global economic policy. At this very moment, lawmakers in Washington, D.C. are locked in debates that could reshape the entire crypto landscape overnight. Proposed legislation ranges from measures aimed at reining in stablecoins and tightening anti-money laundering controls to more crypto-friendly initiatives that would clarify the legal status of digital assets. The stakes could not be higher. A single policy decision could trigger a dramatic correction, or, conversely, could open the floodgates to even greater mainstream adoption. The world is watching with bated breath. Could Bitcoin finally break through the last barriers and become a permanent pillar of global finance? Or will the weight of speculation and regulatory uncertainty precipitate another painful crash, echoing the great corrections of 2013 and 2018? To appreciate the magnitude of these questions, consider the global context. In recent years, the macroeconomic environment has become increasingly unpredictable. Central banks have pumped trillions of dollars into economies to stave off recessions, igniting fears of runaway inflation. Geopolitical tensions and currency wars have destabilized markets. Against this backdrop, Bitcoin's promise as a non-sovereign, deflationary asset has never seemed more attractive. As Lynn Alden, a noted macro analyst, puts it, Bitcoin's scarcity and decentralization make it a unique hedge against the excesses of fiat currency regimes. But Bitcoin is not without its critics or its risks. Environmental concerns over the energy consumption of Bitcoin mining have sparked fierce debates. Some worry that the network's power usage is unsustainable, while others argue that it accelerates the adoption of renewable energy. Meanwhile, the threat of cyber attacks and technical flaws is ever present. The infamous Mt. Gox hack of 2014, which saw hundreds of thousands of Bitcoins stolen, remains a cautionary tale, and the wild volatility of crypto markets has ruined more than a few fortunes. With all these forces in play, what are the plausible scenarios for Bitcoin's future? Let's look at three distinct possibilities. First, full-scale mainstream adoption. If upcoming U.S. legislation delivers clear, balanced rules for cryptocurrencies, and if the Securities and Exchange Commission continues to greenlight innovative products like exchange-traded funds, Bitcoin could become a core component of institutional and even national financial systems. In this scenario, we might see banks offering Bitcoin accounts, governments issuing bonds denominated in Bitcoin, and global trade conducted in both fiat and digital currencies. Cathie Wood of ARK Invest is a vocal proponent of this vision, arguing, "We're just at the beginning of a global paradigm shift. Bitcoin's scarcity and decentralized nature make it uniquely positioned for a digital era." Second, the specialized asset scenario. Here, Bitcoin carves out a permanent niche as digital gold. It doesn't replace the dollar or the euro, but it becomes the go-to asset for companies, funds, and even governments seeking a hedge against inflation and currency devaluation. This is already happening. El Salvador's experiment is just the most dramatic example. In this world, Bitcoin sits alongside gold, real estate, and other non-correlated assets in diversified portfolios. Investors seeking safety from the storms of monetary policy turn to Bitcoin as a modern safe haven. Third, the correction or crash scenario. If regulation turns sharply negative, or if a major security breach or technical flaw undermines confidence, Bitcoin could suffer a significant correction. The same institutional flows that fuel rallies can also accelerate downturns. Professor Ravi Sarathy warns that bubbles are baked into Bitcoin's history. The influx of inexperienced investors, both corporate and retail, could exacerbate volatility. Even Michael Novogratz, long one of Bitcoin's biggest cheerleaders, cautions that rapid institutional inflows can sometimes drive unhealthy short-term price spikes. It's also worth noting that Bitcoin's journey has always been marked by cycles. Each boom and bust has left the ecosystem stronger, but not without casualties. The collapse of exchanges like Mt. Gox, the hard forks that split the community, and the constant tug-of-war between innovation and regulation have forged a market that is both resilient and unpredictable. So what does this all mean for you, the investor, the technologist, the curious observer seeking to make sense of the chaos? First, educate yourself before you leap. Bitcoin's price is driven not only by its underlying scarcity, the unbreakable cap of 21 million coins, but also by waves of hype, sentiment, and the unpredictable tides of regulation. Before committing your hard-earned money, research the fundamentals, scrutinize the motivations behind market surges, and remember, past performance is no guarantee of future results. Second, diversification is your strongest ally. Even though companies like MicroStrategy have staked billions, yes, billions, on Bitcoin, most experts agree that digital currencies should only ever comprise a small portion of a well-balanced portfolio. As Raoul Pal of Real Vision famously advises, in a world of accelerating change, flexibility is your friend. Don't let fear of missing out drive reckless decisions. Instead, approach crypto as one piece of a larger investment puzzle. Third, monitor the regulatory winds. The next chapter of the Bitcoin story will be written not just by entrepreneurs and investors, but by lawmakers and regulators. New laws have the power to open doors or slam them shut. The ongoing debates in Washington, D.C. will have ripple effects far beyond America's borders, shaping the rules of the road for the entire global cryptocurrency ecosystem. Fourth, pay attention to technological developments. Bitcoin's future will be shaped as much by innovation as by regulation. Upgrades to the network, like the Lightning Network for faster payments, or improvements in security and privacy, can unlock new use cases and drive further adoption. Conversely, technical setbacks or vulnerabilities could undermine confidence and trigger sell-offs. Fifth, consider the broader impact on society. Bitcoin is more than just an investment. What has become a cultural phenomenon? Artists ease. From artists using NFTs to monetize their work, to activists leveraging crypto for censorship-resistant fundraising, the social implications of decentralized money are profound. The rise of central bank digital currencies, or CBDCs, adds another layer of complexity, as governments seek to harness the benefits of blockchain technology while retaining control over the monetary system. So, will the looming U.S. legislation stabilize Bitcoin, trigger a crash, or launch a new era in global finance? The answer may well be a little of each. Regulation could bring the credibility and investor protection that mainstream finance demands, but it could also trigger corrections and filter out weaker players. What seems increasingly certain is that Bitcoin has moved beyond the fringes. Its destiny now depends on the choices of lawmakers, institutions, and ordinary people. People like you. And here's a remarkable fact to put all of this in perspective. Back in January of 2009, when the first Bitcoin transaction took place, the entire network was worth less than the price of a single pizza. Today, with each coin valued at over $120,000 and billions invested by corporations and funds worldwide, Bitcoin stands as a symbol of how quickly technology can rewrite the rules of financial history. Let's also consider the global reach of Bitcoin. In countries plagued by hyperinflation, think Venezuela or Zimbabwe, ordinary people have turned to Bitcoin as a lifeline. For millions lacking access to stable banking systems, decentralized money offers an alternative that is borderless and censorship-resistant. This real-world utility, while sometimes overshadowed by speculation, is a key driver of long-term adoption. Looking ahead, the next chapter of the Bitcoin story will likely be even more dramatic. Will central banks embrace digital currencies and coexist with Bitcoin, or seek to outcompete it? Will advances in quantum computing pose a threat to Bitcoin's cryptographic security, or will the network evolve to meet new challenges? Will Bitcoin's environmental impact drive innovation in green mining, or spark regulatory crackdowns? Whatever the future holds, one thing is clear. The financial revolution sparked by Bitcoin is already underway. Whether you are a seasoned investor, a technology enthusiast, or simply a curious bystander, you are witnessing a transformation that is reshaping the very foundations of money, trust, and value. So where do you stand in this unfolding story? Are you watching from the sidelines, cautiously weighing your options? Or are you ready to dive deeper? To learn more, to participate in shaping the next wave of financial innovation? We want to hear from you. Share your thoughts in the comments below. Do you believe Bitcoin is destined for even greater heights, or do you foresee clouds on the horizon? If you found this deep dive insightful, don't forget to give it a like, share it with your friends, and subscribe for more in-depth explorations of global economics and technology. The next financial revolution is not just